A very, very good morning and good afternoon to everyone. This is Pete Reynolds. Just to let you know, we'll be starting the webinar in a couple of minutes. I would imagine at about 3 minutes past the hour. Thank you very much for your patience. A very, very good morning and good afternoon. I'm delighted to kick off our webinar this morning or this afternoon, depending on where you are. On that note, I'm delighted to say that we have a very large attendee group from the United States, from Europe, and from Africa, which is phenomenal. This is actually our 7th webinar with our 8th one tomorrow. So we're being very active on these webinars as everyone is kind of confined to their homes, and we're really seeing a lot of traction, which is phenomenal. Bit of housekeeping before we get going, and before I do some introductions. As you probably know from these webinars, you have the opportunity to ask some questions. Please do. We will either get back to them during the webinar, or if we run out of time, we will come back to you after the webinar session. Also, there will be the chance during this to vote on some polls. We do ask you to vote. We have 3 different polling sessions, and as we get to them, I'll walk you through how you do it. But most of you, I think, are pretty used to this now. And on that, we'll dive in. Let me just, before I do any introductions, let me just walk you through today's agenda, but give you a bit of background. Obviously, over the last few weeks and months, we've had many webinars, many conversations with banks around the world, and a number of themes have come up. And we had some feedback from some of our webinars asking us to drill down into some of those themes. So what we're going to do today is walk you through some of these key themes. Those themes being the changing credit relationship, digitization as a whole, the pace of change, systemization, the need to make money, regulators, pricing and risk, and executive decisioning. Now, rather than just hear from Ernix, I want to introduce you to Dan Bolland. Dan is an associate partner at SEA Partners, and Dan comes to us with a significant experience around credit risk, treasury, finance, strategy, product, and marketing. He's worked on the bank side and on the consulting side, and I am delighted that he's joining us today. For those who don't know me, I'm Pete Reynolds, and I run our global banking business. And we have a very fruitful partnership with SEA Partners, and we spend a lot of time talking to them about some of the strategic and important issues to banks. So I'm delighted Dan can join us today. And what I'm going to do is I'm actually going to take us straight through to our first topic, and then bring Dan in. So our first topic today is around the changing credit relationship. And some of the polls we've done and some of the different sessions we've done with banks brought up to me what is quite an amazing statistic, which is 90% of banks have got unreliable old models, or a large increase in refinancing requests, or an overwhelming amount of credit requests. And this, speaking to a lot of banks and speaking to a lot of webinars, brought up the very real challenge, issue, or opportunity that all of the banks are going to have to really work on this changing credit relationship. And Dan, that's where I'd kind of like to start today on your kind of views on that.
Yeah, no problem. Thanks, Peter. And good job we had a black and white picture at the front, because with that intro there, I would have been blushing, no doubt. I mean, my big takeaway from this stat that as soon as you showed me the other day was, who are the 10%? Like, which banks are not seeing a large increase in refinancing requests, right? Whether it's PPP in the US or and many of the European schemes and indeed globally. I'm not sure who they are. Maybe we just asked them at the wrong time. I don't think anyone's really happy with their models. I think the question here is, look, changing client credit relationship. The key really is, so much of this stuff is reliant on models across the bank, right? Whether that is price sensitivity models, whether it's credit risk models that feed into those, EIR, whatever it may be. I promised I wouldn't say too much about IFRS 9, so anyone who particularly wants to wonk out in that, maybe direct mail me or follow up later on. But to me, it's about how are these things going to start to fit together as we look forward, right? The question comes so often with the clients I work with at the moment on which of these should I change? What should I change this number to? And I think that's almost the wrong question. The question is, it's wrong, and what we need to do is work out how that we're going to learn faster, right? So it's not really about what am I going to change going forward. It's not about trying to predict the future here. It's more about, where is the edge? Where are the moments? Where are the parts of the universe that this could be as we look forward? Because none of us know the future. I have looked on Twitter. There's quite a lot of people on Twitter who seem to know the future. But outside of Twitter, nobody knows where this thing's going to end. And therefore, the most important thing for us is to be able to model many potential different futures and know where our edge is, know where the bank's going to break, know whether that is revenue, liquidity, capital, cost and operational constraints. Where are we going to bust through a constraint? Where is that going to have its most pain? And indeed, right, let's put my positive hat on. Where is that going to create the biggest opportunity? And how do we go about doing that? Right. So we are going to have to react as new data comes in, as the world starts to emerge. And we've already seen some countries starting to loosen up. What does that mean? How is it going to flow through? The key really is, how are you balancing it? And, one of my big themes, and this is going long back, probably as long as I've known you guys, so probably 9 or 10 years, is, pricing is the moment of truth at the front of the bank. It can't solve all of the ills, right? And Lord knows we've got some stuff coming in the front of the bank that we're probably going to have to deal with later. But what it should be able to do is minimize the amount of time that we have to rebalance, right, through non-client relationships, capital, liquidity constraints, right, credit risk issues, return on equity. What is the best use of that? And we have decisions there, and all those decisions are at the front of the bank, right? Don't say no to customers, but reprice those customers. Influence the types of customers that you want, because it's those customers and it's those engagements, whether they're deposits or loans, it's those customers that are going to give us the balance sheet that we end up with, right? We can't just sit there at the front putting out pricing tables and then bemoan later on the fact that we haven't got the balance sheet we wanted, or that our balance sheet isn't right now or ready now for this crisis or another. That we've created that, right, through the front, through pricing the deals and influencing clients to do the things that we would prefer them to do, right? And that's the job of pricing. It's not just, here's a cost card, here's a credit risk card, let's see the highest margin we can get. It's also about balancing liquidity needs and capital needs across the bank, operational costs, and where people are sitting in call centers. All those things are influenced by pricing, and we've got the ability to do those.
That's such a very relevant point about how pricing is such a part of such a number of different parts of a bank. But let me dive into one point you said, and I'm going to specifically look at the SME, the corporate SME lending. One thing that you talked about is an edge, talking about, looking at what you want to lend. There's going to be a huge race to retain business, right? If I'm a relationship manager at a bank in the UK, say, and I've got a book of corporate loans I'm looking after, to retain them and keep them happy is going to be mission critical, I would have thought. What would you think about that?
Oh, big time. And I think, look, for those, some of whom have heard this plenty of times when I'm talking to them already about their SME books, the modeling of that, and maybe this is you bringing me back to the original question you wanted from this, but the credit modeling on that is so difficult now, right? It has changed so fundamentally in the last 6-7 weeks. I have no real concept of time anymore. I just seem to be locked up in my house, and every day is a day. But it has changed so much. The government used to be, and the governments and central banks used to be lenders of last resort. To some extent now, they're the employers of last resort. They're the supporting function for many areas. And a lot of the modeling at the moment, if you tried to do it looking right down at your feet, would be what industry is my SME in, what government support is going to be available to them for how long. And you're almost kind of semi-underwritten by the government. So trying to model that, you get into a lot of second and third order issues. Of course, then, post the next 3 months, nobody really knows where any of this stuff is going to land. There's lots of discussion from politicians and gossip and leaks. And, an awful lot of that doesn't make it down into, actual policy. So, yeah, I mean, I think SMEs are a real knotty issue right now in terms of how and where you could lend to them. You've got, there are banks in the UK today, I don't want to mention names, but, they know who they are, who are lending because they're under such PR pressure from their executives to say something in newspapers, and they do, and then they have to follow through with it, right? Whether demand is there or not, and it broadly is. And they're having to step outside often around policy, and we've spoken to some about that kind of compliance debt that creates. But yeah, I mean, this is, the word unprecedented and the use of it is in and of itself already unprecedented. But yeah, I mean, I think it's a really difficult situation as to what is the question we're even asking, I suppose, is what I'm wrestling with, let alone trying to get around to answering the question of, how we keep these people, right? I suppose I'm empathizing with the difficulty of the situation there, Peter, rather than giving you any silver bullet solutions, right? And the key, and this is a theme no doubt we'll talk about later, but the key is, can you model the implications of lots of this stuff, not just at a client level, but at a balance sheet and sub-balance sheet level for your bank, so that you can know where and when and how much, and at what point does it become, to your point, like, at what point does it threaten a break in the bank?
Okay, great. I think that's very, very true. I'm going to just take us onto a polling question before we dive into digitization. I just want to ask, the question is, to what extent is pricing automated in real time? And you can, on the panel on your right hand side, you can start to vote. I see a lot of you are. The first answer being we have fully automated real-time pricing process. The second being we automate some parts. Third is that we're starting on this journey now. Fourth is on the to-do list, and fifth is, no, we're not planning it now. I think I can tell you now, what we tend to see is, I'll let people answer a few more. I can see we've got about 40% of the people voted. It's going up and up and up. And then I'll relate that to the kind of next session we're going on to, which is digitization. But what's interesting, and I can see this now, is that no one has said they're fully automated, which will kind of lead on to my next point. But interestingly, I can see around 33% of people have said we're automated in some parts. Around 50% have said we're starting on it or it's on the to-do list, and 10% have said we're not planning to implement automation right now, which is, maybe that's kind of, I wouldn't expect that. But I bet you, and as we talk about digitalization, I bet you the to-do list people, I bet it's moved up further on the to-do list. And let me walk you through why as we move on to our next section, which is digitization and a true digital offering. On another webinar, we saw that 95% of banks are unable to deploy new prices automatically, and how this is one of the key enablers to a true digitization in product. And Jim Murray talks about how the pandemic has caused, banks without a true digital offering to be found out, and how personalization is key, and how fintechs have become a very clear and pleasant danger. They've always been something that we've been worried about. They've always been something that we talk about. But now, if you take a normal individual who needs a loan, taking it from someone, like an Amazon rather than a bank, is something that genuinely has probably gone way up in the chances of likelihood. So Dan, from your point of view as an ex-practitioner in a bank, what do you think around the fact that to really have a true real-time digital offering, you need real-time things like pricing, personalization?
Yeah. And just for a moment there, I do wonder if that 8% who are not planning to automate right now, maybe will change their mind by the end of this. I may well go up. So yeah, I mean, when we talk about digital in banking, and digitization. I mean, these words are thrown around. But most, maybe not most, many, no, I'll go with most of the banks I've worked with that have a digital offering, we're talking about digital for the customer and the client, not really talking about digital for the bank. It's so often either kicks off to an offline process and there's people moving paper around and typing in from one system to another, or in the better parts, right, it still ends up with a PowerPoint going to a monthly meeting of Exco or Priceco in order to approve stuff. And then it gets updated into tables, which then feed back into the digital offering and the front end that are often very slick these days for the clients to use. But I think the idea that digital banking, digital offerings are fully digitized is, maybe I wouldn't be as emotive to say laughable, but, you know, it's certainly, let's say, a stretch of the truth, right? And I think it would be interesting, and I often ask it when I go in, but, you know, for those on the line to think about how digital is our digital offering and how much of our pricing is down to one meeting, normally an hour long, because that's how long it takes a minute hand to go round the top of our clock and back again, once a month, because, you know, as what was it, 16th century Pope decided we should have a 12-month calendar. Like, those things just don't seem relevant to me as to how to price events for clients, right? Clients don't need a loan because it was the third Tuesday in the month at 2 o'clock plus 3 working days to process the pricing change, and then they want to know what price it is, right? Which the reality is a lot of what's behind digital offerings is it's just got to go through Priceco and then 2 days to update. You know, the customers, clients, whether it's SME, whether it's personal, there's a trigger event in their life, in their business, and Lord knows we've had plenty in the last 6 or 7 weeks, you know, and that could be government grants and whatever it could be, that creates a need, right? And that person has that need right then. It's not the need that we modeled 3 weeks ago because we're on a 1 month cycle. It's the need they've got right now. And the closer we can get to that, the tighter we can get to that. I think that's more like what people at least thought they imagined a banking relationship was back in the 1930s or 40s or wherever people believed these great days where their bank managers really knew them, really knew their business and really understood them. You know, we've centralized and with FICO and all of those things, we did some amazing stuff through the 70s and 80s and bank returns did very well. But, you know, how do we get closer and back to that? Because we've got a lot of that data now. We know what's going on with their business, possibly before they do. And we've certainly got lots of options around big data. I suppose what I would say, though, when I say move to digitalization, that isn't, I'm not some kind of something agile, something, you know, freedom warrior, something immutable code, blockchain, anti-governance fighter. You know, this is about how do you get the right governance at the right time. You know, I question whether monthly pricing tables go into price codes that now often have got like 5,000 prices on. How many of them are really being reviewed and governed anyway? I mean, they just go in the appendix, they get printed out, and internal audit, they come and do a review of it. How many of the people in that room really know where the prices are? And you can't know that on a price of 5,000 table, but you can know it if you start to think about where are we playing, why are we playing. You know, I said to Peter, I wouldn't use phrases like a fishing frontier, but, you know, how do we know our universe and where do we want to play in that? Are we lower than our competitors and we want to just be there, never knowingly underpriced or whatever it would be? Or are we want to lend to people when they need it, only when they need it, at a fair price for us and for them, whatever it may be. And what does that mean in prices? And how do I picture that? And the answer to that is not going to be PowerPoint. It's not going to be large tables in Excel, right? There's got to be a way for them to move around it. And the more they can interact with it, and the they being the people who govern these things in an easier way, then I think we can start talking about really are governing our prices and we have transparency through our management. I mean, sometimes the regulator starts to ask more questions than I think the management does in these arenas.
Which I think we're gonna come on to. And let me move on from this, but just say one thing, and that was, it was a customer in the United States that actually linked to me pricing and digitization. And they asked us to look at, I won't go into too many details, but they asked us to look at all the different pricing that they did that included negotiation. And their point was, until we get rid of negotiation in pricing, we can't digitize our offering. And I thought that was a very good way of looking at it. But I'm going to move on.
I just say on that one, Pete, I mean, I just think that there is about, you've got to digitize the range, you've got to digitize the engagement there. So that isn't the price. Relationship managers need range. Otherwise, what are they doing there? They need to be able to say, well, look, I tell you what, if I could negotiate this, and then if I could do X, then you could do Y. If I could reduce the balance, could you reduce the margin? We've got to empower our people from there.
Yeah, now I'm going to move on to the pace of change. Before I do, thank you very much for some of the questions we're getting. Please do keep them coming. As I say, if we can't get to them today, we will come back to you individually. On pace of change, I just want to make a few points that things have changed in a crazy speed. I mean, there isn't a country that wouldn't say that they've had unprecedented government intervention. That in itself has changed the fundamentals of risk, along with everything else. And banking operations not ready to face pre or post COVID challenges. It's interesting, like we have a customer in Asia who was halfway through deploying some of the pricing in different lines of business, and they actually have decided to actually change some of the models that are going into the deployment, because what they were working on 5 weeks ago and what they're working on now is completely different, which is, to me, it's interesting, it's exciting, but it's kind of crazy. Dan, your view on, typically banks aren't necessarily set up so well to deal with the pace of change. How do you think this is going to impact the banks?
I mean, yeah, without going completely over some earlier ground that I covered, I mean, in some sense, I feel like you could return to line 10. This is about, I don't know, how would I phrase it differently? You've got to embrace the uncomfortable nature of looking out of a front windscreen, right? So as we look forward, we don't know where the road is going. It's definitely foggy in front, right? We don't know. No one knows where this is going to end, how it's going to land, and what that looks like. I deny anyone who says they think they do. So there's a nervousness with that. So I think the instinct is to kind of turn around and look at what we do know, because the rear windscreen is absolutely clear. We can see exactly what's happened, and we look back, and if there's any bits and spots of mud or whatever, we clean it off and we change our data and we interrogate one or two issues, and that's comfortable for us because we're quantitative people and we want to get stuck into that stuff. But it's not going to change the future, right? We've got to turn around and we've got to embrace that uncomfortable feeling of looking outside the front windscreen. Right? That's not about what's happening immediately now. It's not about knowing the future. It's about modeling where that future could go, what the impact for our bank or our product or our area or our client base that would mean for us. Don't try and predict it. Know where your edge is. Know where the things get really, really hairy. Know where the things that would break the bank or cause a huge issue or run out of capital or liquidity. Understand that, and then reduce the risk of being there, right? Or know, if you started to get close to there, what you would do. If I was to carry on with this analogy of the car, when do you put the brakes on? When do you just try and steer away from it? And knowing those things, that isn't what is the most likely path forward, and then let's just assume that happens. This is about uncertainty. It's not necessarily about risk. This isn't all modelable. And without sounding like Mervyn King, you've got to embrace that uncertainty and have ways to manage around that. What that doesn't mean is throw your hands up in the air and make a gut call. That means model many futures, understand where they go horribly wrong, or indeed go amazingly brilliant, and try and influence it the way you want it to go.
Yeah, but how about this for a scenario, right? I'm a bank that's been collecting data brilliantly, and I would chuckle that not all banks yet have the ability to get the data they need. But let's just assume you're running pricing or risk or whatever it might be for a bank. You've been modeling data for 10 years. You've got great data, and you've got all sorts of kind of scenario analysis you can do with that data. All of a sudden, you've got two things that you wouldn't have bet, on Christmas Day as you sat down for your kind of Christmas turkey, and someone had said to you, hey, in 5 months, every bit of data you have will now no longer be valid. And secondly, I won't be able to tell you what the next 5 weeks, 5 months, 5 years will look like. How is that, just from a practical point of view of the person who still has, banks still need models, right? How are you going to deal with that? That to me seems like one of the biggest changes we'll see in the immediate future.
Big time. And I would say that it's not necessarily the best modelers or the best predictors that do best here. It's those who learn the fastest, right? So that isn't just to say the human beings have a propensity to be able to learn fast. That is, what is your governance? I'm going to sound really boring now, but what is your governance structure, operating model? How do you feed into those things? How do you, as a business, as a bank or a lender, I'm sorry, I've got some payment providers there, I've seen that as well. How do I learn faster? How does the system, the business that I'm in, learn faster? What does that look like? Again, I said I wouldn't use the phrase, but you Bayesian loops, how are you going to make those learn faster? What are you going to weight more? How does that go through? And that is down to management call and understanding, right? That's not down to, I want to buy a better, cooler tool. What the tools in this area could do, and obviously Ernix is great at this as well, is allow you to model many of those futures, allow you to re-weight some of the more recent data you've got, start to play out with where that might end up, and start to understand the universe and realm of potential as we look forward without knowing it. There is no knowing of the immediate future right now, but there is understanding that if it goes to X or Y, then the impact is Z. But if it goes to A or B, we might be able to get to C, right? And it's about understanding that faster, and you will not do that without tools. Right? You just cannot do that.
Yeah, I think, and we're going to come on to systemization, so we'll carry that theme on. But just closing this out, one of the things I've seen with our auto lending customers who maybe are in a good position that seems to be, and again, I'm using 2 weeks of data, not 5 years. It seems to be a sector that is recovering quicker in some countries that are coming out, which is good news. But we're seeing that the ability to take a small amount of data quickly and make a decision seems to be almost becoming a competitive edge, and that you need to make sure that you don't get paralyzed by having just by having a small amount of data. That seems to be something we're seeing, across the world as people at least start planning for what everyone's, popularly calling the new normal.
Yeah, absolutely right. And even if you're on 1 week loops, knowing where you can place more chips, where you are comfortable taking on more risk, and where you're fearful of taking more, right, in a realm of everywhere being more fearful, that's the power, right? That being able to enable, rather than having every time having to check, manually underwrite, whatever it may be, to your point, being able to execute faster in an area of comfort within a realm of acceptability that's determined by the management. I think that's the only place you can be and move fast in especially things that are highly commoditized like car loans.
Yeah, and you talked about, moving on to systemization, you talked about a couple of things there that we should go into here in a bit more detail. But one of the three kind of themes I see is that why do we talk about, or why is the market talking about systemization? I think I had two themes, and then I started reading some stuff. But obviously people are trying to do more quicker, talking about some of the banks trying to get money out the door to lend. People are trying to do things in a smarter way, because you're right, we're not making decisions with all the data. So let's try and be as smart as we can. So you've got a need for velocity. You've got a need to do things smart. I also, funnily enough, started reading all the bank Q1 results that are coming out. And there's a theme I'm seeing, which is the cost income ratios of banks changing to something that isn't going to be comfortable. So one of the ways that you can approach cost income ratio is how can you systemize things? So I think that's very, very exciting. So maybe just focus on that, and then I'll come back with another question, Dan.
Yeah, no problem. So, I mean, systemization, I look back. I mean, can I look back to a time? It feels like a totally different time, but at the start of my career 20 odd years ago, and we worked in an analysis team, and Exco would meet and they'd do a bunch of stuff, and they'd ask us one or two questions, and then it would be like, people would come out of the meeting, and the director in team would say, look, this is where we've got to run some numbers on this. We've got to run some analysis on where we're going to be, how we're going to do that. Right? And it would take us all month to answer those one or two questions, socialize it, and present back to Exco every month. Right? That was it. It was like our job was Exco are going to ask some funny questions, and we're going to be able to answer it in the month and go back. And we thought we were really cool because we had some VBA codes behind Excel, and because we could pull in a bunch of data after asking Jeeves or whatever it was, right? The problem now is it's flipped, right? That was the age of that was the age of the answer, if you will, in that all we wanted was tools to help us answer questions faster and faster. Now you can run something, you could probably answer 1 billion questions in a month now, given the amount of automation, given the big data sources we've got, given the tooling available. And people are still talking about we need to go faster. I mean, that makes me laugh. We don't need to go faster. The challenge now within analysis, especially within banks in terms of the data we've got, is what question should Escrow be asking, and what question should we be answering for them? What are the most pertinent questions? Where is the edge to our kind of universe of opportunity, right? Where are the areas of fear? These are the really big questions. You know, there was someone, a client I worked with, who said that 2 of the guys in their team have managed to model out what they think the average shoe size is for male and female customers, because they've got a new big data feed and they can model it out based on some Amazon data. I mean, that is really impressive, right? The average shoe size of your customers, and they could split it by region. I don't know what use it has, certainly not in any credit decision or price propensity model I've ever seen. It's really important, but it's clearly a waste of time. Now, that was a flippant time before the Corona event, where we could have fun, I suppose, on these things. But, you know, the anecdote stands. What questions are we really asking? How are we dealing with that? Use the systemization to be able to answer the biggest questions there are. And when other questions come in that are more trivial or whatever it is, let them self-serve, right? Let senior people be trivial if they want on 1 or 2 smaller items. Certainly, we don't use any of the modeling or analysis team to be, what was our margin last month, right? Where are we going to be if we stay on planet volume? Those aren't questions that need analysis anymore. They can be totally self-served. The questions are, you know, where are we on the efficient frontier? How far off are we? Should we move up or down? Where are competitors playing? Where do our clients need us most? Where do we need for our clients to play most in order for the best of our balance sheet? These are the really difficult questions. And again, they're uncomfortable because they're hard to answer. They're open-ended, unlike what is the margin going to be, or indeed, what is the shoe size of our customers? So I think that's the challenge in systemization, not doing what we used to do 10 years ago faster. That to me is trivial. The thing is, now we can truly start to grapple with some big questions that are incredibly pertinent right now in the time we're in, as to how we deal with some of these issues.
I think I also think there's going to be a big challenge posed to the people who provide and help banks with systemization, which is this point on speed to value.
Yeah.
I think there was a time when banks were known for big technology projects, and you could solve the world and then implement it over 5 years, and it was fine because the world might not have changed that much in 5 years. I think now, given economic pressures banks are under, and also the way banks are thinking they're going to have to change, there's going to be amazing pressure on the speed to getting value from systemization. So I don't want to systemize my whole bank in 5 years. I want to systemize this problem in 2 months so I can get value from that and then move on. The problem that, say, a bank that's got unprecedented demand and needs to get loans out the door, that they don't want to come and have a pitch and say, if you'd spent the last 2 years, you know, taking our loan processing module, you know, that's not what they want to hear. They want to hear is how can we react to the problem we've got now next week? And I think that's where there's going to be a lot of pressure putting on the kind of vendor community who might not have the right model to fix the problem at the speed that the bank's got the problem. Does that kind of make sense, Dan?
I think it makes sense. You'll tell me when I said it, when I continue now. But yeah, I mean, I think you're right. I think there is a real danger that, you know, this crisis comes along and, you know, everyone will try and say clever things like never waste a good crisis, and they'll open up a 2-year program in order to solve something very clever, strategic need, and it's all too late, right? The question really is, it's not what am I going to do now? I don't think that is quite the pertinent question, albeit I was being asked that question a lot 3 or 4 weeks ago. I think the question really is, what should I be doing for the next 6 months? What should I be doing for the next 2 months? Those are reasonable questions because we can really impact those things. And the great thing about pricing and working in pricing areas and challenging and changing the way we price is that the effect is immediate, right? If we change prices, then it follows the client behavior will change, unless you know, various places on propensity, and we can affect the type of business that ends up on our balance sheets, right? I mean, that is the moment of truth that pricing brings. So the challenge really is, where is that best placed if I've not got models now? Where should I place my bets? And a lot of that comes down to, well, it kind of depends where you are today, right? But to your point, you've got to be able to show value quickly. I wonder if speed to value is quite the right phrase, or whether it's speed to avoid losses would probably be a better phrase for right now as I look out the window. But yeah, I mean, how do you get there quicker? Where do you know where your edges are faster? I think is probably the most pertinent question right now.
Okay, well, you've mentioned two interesting themes so far, and that is the use and the importance of analytics, and then how you systemize that in a way that it's useful. So let me just quick jump me to a poll for our audience. I'm going to ask the question here about what level of analytical systemization is there in your organization. So let's just a reminder that you vote on the right hand side, and I can see lots of you already have, so that's great. If you look at number one is fully systemized, number two is multiple systemized process, number three is only starting on our journey, and number four is no systemization. And we have so far, gosh, that's interesting. We have half of the votes. We have half of the votes, so 50% so far, and 50% of 50% of the attendees are only starting on their systemization journey. And like you said before, I'm fairly sure that's going to be something that gets speeded up, pretty much into the forefront of people's day jobs. So we got most votes in, and yeah, so it's the majority. So 71% are starting on the journey, and 30% have multiple systemized processes. And that's kind of what I would expect. Before, if you just comment on that before I take us on to our next subject.
Yeah, I mean, I think people are obviously fearing the very edge there, right? In terms of fully and no, do we have, I wonder what some of those systems are. They might just be Excel and Outlook, but there we go. Yeah, I mean, I think, look, it's interesting as well, because I think if you ask someone, how systemized are you 6 months ago, and or where would you like to take systemization, I'm not sure necessarily they would answer the same today. I'm going to use my windscreen analogy again. It's comforting that when you look out the back window in general flat terms, and you're just tinkering along, and the front window looks like the back window anyway, it's comforting to just say, well, we'll just do on the back window because no real change. It's much easier. We've got better data. And then something like the last 8 weeks happens, and suddenly you realize it's all for the fishes, right? And you need to change all of it. So I think it's interesting if we could unpack some of those, and maybe people will do that offline in terms of what they were aiming for with systemization, where it's still the same thing, because one system isn't the same as everybody's system.
Okay, let's move on to what I'm calling the need to make money. And let me just pose a kind of point to you that came to us from a customer, which I never thought I would have this kind of level of detailed conversation. But we were talking about lending money, and they were talking about the need to get money out the door. They were talking about the need to lend. And you kind of made this point that sometimes a bank might be influenced by a marketing message of, we're going to do this, and then they have to do it, which I totally understand. But the question that was posed to me that I want to talk about was that because they know that some of the lending they're going to do today isn't going to be at the margin or KPI that they might have done had this not happened, it's going to make the wider KPIs and performance of the overall book even more and more important to the bank. And I'd love to get your opinion from both a banker and a consulting point of view on kind of what that means for the next 2 months, 6 months, when it comes to looking at the book and looking at new originations you might plan to do in the new normal.
Yeah, for sure. Okay. So, and can I just slightly widen the kind of definition of need to make more money in terms of that isn't just necessarily product margin, right? So I see an awful lot, and I've done an awful lot of work with people who in the pricing team are just they're like, well, I'm given my FTP and I'm given my operational costs, and therefore I just try and maximize my margin here. But actually, the really good job of Pricer and the pricing team is to balance for liquidity and capital needs. And when the bank is running hot in one area, the more liquid products can turn the ship slightly and bring more or less in of their product, depending on which side of the balance sheet they're on and what the bank needs. And how do you balance that? Because I think that's what truly good pricing is. And that makes more money, because it means that the Treasury don't have to ring up JP Morgan at the end of the month to square the circle, and we were too long here and we were too short there, and we didn't have enough 2-year money, and we had all 3-year loans, and whatever it may be. They're all things that get influenced by pricing. And if you can balance those via pricing, and you make positive margin through those clients, then you make money on every deal. When you deal with JP Morgan at the end of the month to square it off, I guarantee you're going to lose money, right? So how you minimize that kind of leakage is also how you make more money, and how you make a stronger and more stable and more diverse balance sheet is again how you increase share price. So I think it's a little wider than just margin, but I think all of those things can be modeled. I've certainly worked with some of your customers on that in terms of how can you make a better balance sheet, not just a better margin. FTP really is just a function of what comes through the front door anyway, and that, of course, is a lever that's controlled through pricing. So I think that's where people need to focus on in terms of the lending at negative margin and government supervision. I think you could put in there the kind of general society, and this isn't to demean it at all. I'm all for it. Is the pressure to lend to businesses and to people right now in their most urgent need, and we're all for that. But I think what it will do is lead to, should I say, a lot of inorganic activity. And I've seen there's a few people on here from Alantra. I'm sure their phones will be ringing off the hook as soon as people start to settle down and start to realize what they've got in their balance sheet, what fits their brand and their balance sheet needs, what they would like to keep, what they definitely don't want to keep, and maybe some stuff in between where they don't really want to, but they don't like the price either. As always in this arena, those who can model what they've got and what they want to keep and what they don't and can act on it fastest will get the first buyers of that. Those first buyers will run out, and of course the second buyers want it at a better price. So there is definitely a first mover advantage in understanding what you've got, what you're going to have, and then what you're going to do with it. In an ideal world, you don't bring any of it onto your book and it's all dealt with via pricing, but we're not in an ideal world right now. We're in a world where banks have to lend and we have to get it out there. Not just for the face, not just for the form of PR, but for the substance of PR, right? We do want to sustain our clients and our customers. We do want to do all the right things. We just have to live with the consequences, be that compliance or balance sheet pressure, later on, whether that's kind of an FCA pressure and a compliance side, or whether it's a PRA, what is your balance sheet and why is it so sick? Those things are going to need to be dealt with, right? And I would say the faster you can understand that, then the more influence you can put at the front, if you have any, and certainly the faster you can deal with it at the back end in terms of inorganic transactions and trying to clean it up as fast as you can. We certainly saw that coming out of the crisis, that those who were able to act through 2010 certainly ended up in a much better place than those who ended up dealing with it in 12, 13 and 14.
Yeah, and I think maybe it's a good lesson to me, a fifth bullet on this slide being the people pressure, right? There's a huge amount of public perception issues banks have to worry about now when it comes to loans and pricing and mortgages and all these things. And I think it was really summed up well to me by a CEO of one of our customers who talked about, when he thinks about pricing, it's about obviously giving a customer a loan that is affordable. That makes no sense not to do that, but also to run a sustainable bank, right? I mean, we can all bash banks, but we all want banks to be around in 10 years because we use them for a lot of things. So the bank's got a responsibility to lend in a way that makes sure it's a sustainable business, so it's a real, eye of the storm at the moment of getting that right. You mentioned something I'd like to move on to now, and I should say that there are other banks as well as JP Morgan.
Sorry, all the banks or other investment banks are available. No, absolutely, and we've got many on the call here. I was trying to pick one that wasn't on the call because I don't want to be seen to favour anyone.
Let's move on to a subject that you talked about, which I think going to be fascinating, and how the regulators and looking at pricing and risk is going to kind of be very important, and become a real focus for the banks. So I almost say here that the regulators have a new role. Now, it's not new, but it's going to be much more important. And from your experience, when you're at a bank and how that's evolved, how do you think that's going to impact, number one, the banks, and number two, us, the customers of banks?
Yeah, I mean, I feel like I need to unpack almost every word in that question. I mean, first of all, you saying it's really interesting about regulators. I'll let you decide if you're the interesting person there, Pierre. But I mean, if we can just unpack regulators, and I know it's easier in the UK because we've kind of got this split role between the PRA and the FCA, but I think it's fair in all of the regulators around. Certainly all the banks I work with, and it's not quite as pronounced, I would say, in some of them in Europe when I work with some of those banks. But that kind of classic tension across the regulator between they want a stronger balance sheet, they want more capital, they want greater returns, they want a stronger balance sheet, and then on the other side you've got the conduct compliance, don't lend unless you know everything. We only we want to understand everything, and then you take it into the last 6 or 7 weeks. And you've got CEOs and government people speaking and agreeing to numbers, firing them out, and ending up at a pricing desk, not the other way around, which would be normal, that a pricing desk believes we can, and therefore the CEO or someone senior speaks to the government to try and lower. It's all gone the other way around. And there are some banks, and I see some of them on this call, and I don't want to mention any of them, they know who they are doing stuff that is outside of not just a pricing process, but, you know, on the very edges, let's say, let's be kind, of the compliance processes and what they've gone through. You know, Wells Fargo got publicly told off in the US for not processing enough PPP, and they said, but it's because our compliance checks take 3 days. You, the regulator, said our previous ones were too quick. So I think in all of this world, there's a tension that's bubbling up, and I don't suspect that there'll be much forgiveness from the compliance and conduct side of the regulators, because we've been put on pressure to keep the economy going on the other side. I think those things are all too quickly forgotten. So I think those who can understand where they've stepped outside of those things and where they would have rather done other ways, whether that's on compliance or pricing, so you can lead to inorganic activity, or you can hold your hands up to regulators. I know we're doing that with a few banks in terms of understanding their compliance debt and what they haven't been doing in order to go back to regulators and say, this is what we would have liked to have done, but the public and societal pressure didn't allow it. And that rolls right through for pricing, right? Is that there are things happening today that the pricing team haven't really approved at the prices they're going out at. What the pricing team can't do, I think, is just say, well, you know, let's shrug our shoulders. It is what it is, que sera, sera. I think there's more on, okay, how do we influence that as we go forward now? How do we get on the front foot with some of this stuff? You know, and how do we model where and when we could get to in terms of if we need to rebalance wholly organically, or whether we can do some inorganic things and model that out. And again, sound like I'm on loop again, if only I had something interesting to say, is, you know, there is a first mover advantage to this stuff. And this is one area where you can start to model. I know I'm all about how many options and the uncertainty, but this stuff's just a risk, right? You've booked the business, you broadly have a view of where the client is and what they're doing, and you've got a model. Would you have written it to that price, and would you want to keep it at that price? I mean, the big one for me when it comes to regulators is not just transparency to the regulators, because it makes me laugh when people say we'd like transparency for the regulators, but then they don't have transparency for their management. And I think that's a dangerous cocktail. Is how do you get transparency and understanding? And by that, I mean, you know, every deal a bank does with a client or a customer has a different risk reward. Even though you go, well, these are our mortgages, and these are our secured corporate loans, these are our SME deposits. They've all got different risk reward profiles to them, and that's why they often have very different prices, right? I mean, I agree. In some banks, they have very similar prices, and there's certainly lots of that shouted about at the moment. But because they have different risk reward profiles, how do you know if and where there is any cross subsidization? How many of those risks are short-term credit risks? How many of those are structural, societal, post-COVID-19 event? We don't know whether these types of businesses will exist forever. How do you price that in from a risk-reward point of view? And the key really is to learn fast and know where you've got homogeneity and where you've got heterogeneity, and where you should, as a management, be pricing these differently, and you know that you are or you aren't for whatever reason, and just being transparent and understanding that. And I think that then leads to better relationships with regulators, because you understand it more. You don't have to give them all the transparency. As long as you have it, I think you can speak clearly to where you're standing and what you're aiming for. You know, people who say, well, flat pricing is better. Well, but flat pricing, on the assumption that all customers are not the same homogeneity profile, then obviously it's not better, because you're cross-subsidizing from one to another. The key is know where you're cross-subsidizing, if at all, know where your pools of heterogeneity and homogeneity are, and I would say this now, you know, it's very pertinent, how do you learn that faster? Because what was homogenous yesterday, I don't think is homogenous tomorrow. You know, what are correlatory factors in terms of whether they are risk scorecards or whether they are overall profiles? Those things are changing. The data may be the same, but the power and how they fit into the models must change, because the world is so different now, at least in the medium term. Who knows what normal is and whether that comes towards us or we go towards it. But, you know, knowing where your homogeneous pools are, I think, is key to being able to price for these things going forward.
Yeah, I completely agree. And I've even, banks have even started talking to us about how using the regulators as a partner. And that's something I would never have thought, like ending last year. I mean, regulation has always been very important when it comes to pricing, and especially you look at retail products and you look at how you price different parts of the retail market, then that's always been very interesting. that kind of links nicely onto my last kind of subject. But first, let's do a polling question. And I apologize to our audience. When I wrote this polling question, there were 2 answers, but then, you know, Dan's a consultant and he made it from 2 to 6, which is a great business model.
It's a 3x increase there, Peter. You're welcome.
Yeah. So let's just have a quick vote on this before we go on to talking about pricing committee. So what does your pricing committee focus on most? And most here is the point. So last month's and this month's pricing table, balancing risks, operational factors, returns on liquidity, new business scenarios and the edges, as Dan was talking about, that might be headed into avoided, strategic desire versus actual performance against the efficient frontier, other providers' previous pricing movements, and actual volume versus targets. So I'll just give you a few minutes there, and we're getting this is quite interesting for me because we're getting quite a split. So no one at the moment, which is interesting, has voted for new business scenarios, which is interesting. They have now. So we, and by saying that, we now have boosted them up a little bit. I feel like Simon Cowell when he's doing the talking about the votes coming in on Britain's Got Talent. But okay, so they're very split. The winner actually is balancing risk, operational factors, and returns to liquidity. And Dan, think about that for a minute, and let me take you to this next slide, and let me just paint 2 pictures. I want to paint scenario A is a pricing committee that meets monthly. You can picture it, pinstripe suits, sat around a board table, you know, a bit of a lunch afterwards. Let's talk about pricing. What are our competitors pricing at? You know, what did we price at last month? And then let's go to the other side and talk about a very complex computer using machine learning to work out what everything's doing and pricing in real time. Now, I totally understand that you've got 2 ends of a spectrum there, and I think, and my view is that the majority of banks are still far too put towards the left of that, so that the kind of meeting monthly and not necessarily do it using the technology that we have at our hands to kind of price in real time and data-driven decisions. I want to pose a question to you. So to start, what's going to happen to the monthly pricing committee based on what you've seen in the last 7 weeks?
I mean, it does make me laugh. Our ability to process, to segregate the amount of banks I go to who are aiming for segment of 1 or whatever it may be. Don't get me started on that. I know you don't want me chatting too much on that one. Direct mail, if you want to rant on that one, I could probably put it together pretty quickly. But yeah, I mean, the amount who want those types of things and want faster and more pricing tables. And last bank I was with, 60,000 pricing points just for their unsecured loans. And yet they still only have 1 pricing committee a month. It's still only an hour long, which, you know, take 10 minutes either side. Is probably 40 minutes in between. And, you know, the packs are 70 pages often. And you're thinking, if you want to price faster, you've got to find a better way to use that 40 minutes rather than just showing me all of the prices, right? At what point does that just become ludicrous, right? And therefore, I think the key for pricing committees is trying to understand where they're trying to play with their brand, right? Where are we playing? In what pools are we playing? And what are we doing in those pools? And if you don't know the answer to that, I would suggest that you're probably losing value anyway. So where are we playing? What are we doing there? In what is the boundaries in which I would allow the pricing freedom, right? So where would I allow you to increase volume because competitors have come out or because demand has increased, right? And obviously this is easier to talk about in commoditized rather than relationship-based products, but the same broadly applies. Is trying to understand the realm, the universe of the possible, and then where you're going to allow some kind of responsible freedom in which to execute, right? You know, as an example, UK mortgages, let's say, was a great one. About a year ago, I did a review for someone, and mortgage margins are broadly halved for them, but they were continuing to go on because their pricing committee only met 6 times a year, so every other month. And in between, mortgage rates had halved, but they'd promised a certain margin by a certain volume. And they said, well, look, we're going to do the volume, and we are price takers on margin, so we just went to half. And you know, like, how is that agreed? And they're like, oh, well, it's kind of unwritten that we always get the volume if we can't do volume versus margin. And you're thinking, well, that doesn't make any sense if deposits are also suffering from a margin compression, because the bank's just going to lose way more money. But it's like, well, that's not what we do though. And that's where I think pricing committees need to be a bit more holistic. I'm not saying you need a pricing committee for the whole bank, of course not. Imagine it quickly looks down the list for large global bank that's not on here. If you're at Citi, that's just impossible, isn't it? So, let's be realistic. But you should have a global sense for pricing. You should be able to influence unsecured loans to say, we need more 3-year assets right now because that's where our deposits are sitting, or indeed some other model in terms of how that plays out. I think pricing committees have got to be much less about the detail and much more about the why are we here, why are we writing this, is it still making sense? Because at that level, the question is always relevant, right? At the level of should we do it at 25 bips or should we do it at 80, that can become irrelevant pretty quickly in certain external events.
Yeah, gosh, you mentioned things there that could be, webinars in their own right. Just especially, I love the idea of how you can balance the different types of, lines of business lending you want because of where you are in deposits, and that's maybe something that links into systemization, that links into so many things. It's 5 minutes to the hour, and I'm under very strict instructions with our marketing team that we don't keep going longer than we say we will, because it kind of doesn't respect everyone's time, and we've got many questions. So actually, I think I'm going to give you one, Dan, if you can try and answer it very quickly, and then we'll go into the others. We'll get back to everyone individually. But I like this one. There's going back to a point we made on SME. So with retention going to be a key strategic point post-COVID-19, and also corporate SMEs under huge pressure, in your opinion, how low can banks go from a pricing point of view? And is there an exit price, or do we focus on retention and future revenues? And I say this with a caveat that if I'd asked you 6 months ago, would you ever be paid for taking oil? You would have said no. So take it from the point of view that everything's possible.
Sure. Yeah, absolutely. And, without being the pricey pernickety guy, it was only one type of oil on one specific day. But no, I take the point. So how low do you go? Look, I mean, that depends on where you are. It depends on the wider balance sheet. It depends on, the market positioning of your bank in terms of where you're to grow and where that's going to be. We know that SMEs are sticky generally, right? That is to say, they tend to stay with who they are through thick and thin, as long as you don't hit some red flags, right? And the biggest red flag on that is you won't lend to me, right? We also know that it's very difficult for especially SMEs to just go next door and get a loan, right? Because they have to have a relationship. They want to see their checking account deposits in there. So I'm not saying utilize those, but there's a lot of chaos at the moment. I think a lot of this is going to come down to what the governments are going to do, and the answer to that will be varied, no doubt, across many different countries and regions as this thing unfolds. I'm going to sound like a consultant now, but the answer is it depends. He says to the wider audience, if the person who sent this in specifically wants to talk about some of that stuff, I don't mind doing some of that offline, but it's going to very much depend on where they are at the time.
Okay, and definitely we will share the contact details, and we can definitely have those conversations. I think it's a very interesting subject. I do need to now say a couple of thank yous. Firstly, thank you for all of you. It's a privilege to have you on our webinars. We love keeping in touch this way. Please all stay very happy and healthy. Thank you very much, Dan. We don't pay Dan for his help on these things. So Dan, please, thank you very much for joining us, and here are Dan's details. Please get in touch with anyone at the Earnex team. We are more than happy to point you in the direction for extra resources. We're more than happy to point you in the touch of our friends at SEER Partners, and very happy to carry on the conversation. Please do visit the Earnex website. We have a whole series of banking webinars, and my colleagues on the insurance side have a series of insurance webinars that really are very well attended. So please do check there. And apart from that, I just want to say a big thank you to everyone. Thank you to our marketing team. This is, as I say, I think our 7th webinar we've done under lockdown, and I think they're going pretty well. And that is the official end of today's webinar. Thank you very much indeed.